Welcome to the Understanding Assumed Pensionable Pay Employer Webcast. My name is Richard Quinn and I'm one of your Employer Pension Fund representatives making up the Employer Relations team, and I will be guiding you through today's session. The purpose of this presentation is to provide you with an understanding of how absences are dealt with in the LGPS and dealing with assumed pensionable pay. If you do have any questions, please refer to the Support is Available Now slide, which provides you with the different options to contact the Employer Relations team here at West Yorkshire Pension Fund. And you can contact us with the specific details of your inquiry, and this can be investigated further for you. First, let's look at the key points that will be covered in today's session. In part one, I will provide you with a quick recap of the care scheme to set the scene, to really outline the implication of absence, and if not dealt with properly, the implications this can have. I will talk you through assumed pensionable pay, which I'll refer to as APP from this point onwards, covering the theory, how to calculate APP, how to apply APP, and I will also talk about increasing APP. But this is quite a rare scenario, so it's just to make you aware of it. I will then provide you with a demonstration of the various scenarios you may encounter when dealing with APP. This will help you see working examples to assist you with applying APP for any future cases that you may come across. There are other scenarios where APP is applicable other than absences, so I will talk you through the additional scenarios that would require you to submit APP. In part two, I will outline the key resources available to you as an employer to assist you in your duties and also to further aid your understanding of APP. However, there may be occasions where you're not just sure how to deal with a particular scenario and just need some further guidance. So if you do require further support, I will advise you of the various ways you can get in contact with us. From the 1st of April 2014, the LGPS changed to a career average revalued earnings scheme known as a care scheme. This means that the pension builds up as an average of the pay that the member receives throughout their career. So for each year they work, we look at how much pensionable earnings they've received and take that figure and divide that by a 49th, which is the accrual rate of the scheme. The accrual rate is simply the rate at which the pension builds up. If the member was in the 50-50 section of the care scheme, the accrual rate would be a 98 and would mean they build up half the pension they would build up had they been in the main scheme. So each year, the annual pension members' purchase is revalued in line with inflation and based on the Consumer Price Index, known as CPI. This allows pensions to retain its value through to retirement and in line with the cost of living. So if you can afford your favourite takeaway coffee now, you'll be able to in the future. If we look at the example on the slide, the pensionable pay the member received is £25,000 per annum. The accrual rate, if you're in the main care scheme, is a 49th. So a 49th of 25,000 would purchase an annual pension of £510.20. If the member was in the 50-50 scheme, the accrual rate would be a 98th and would mean they build up half the pension had they been in the main care scheme. So as you'll see, each year £510.20 is built up and added to the member's pension pot. Where a member's pensionable pay is affected due to absence, this will affect the pension that member builds up. So, for example, should the member have suffered a reduction in the pensionable pay they receive as a result of sickness, their pensionable pay reduces to £12,500. So, based on a 49th, the annual pension this would purchase would be £255.10. So, as you'll see from the slide, there is a significant drop in the pension the member will be building up. If the member's pensionable pay is affected due to absence, this will affect the member's pension. So the scheme aims to protect members' pensions build up for certain types of absence. And APP should be used in replacement of the pensionable pay received when the scheme member is absent for any reasons that is considered protected leave. So with the introduction of the care scheme, the scheme aims to protect the pension members build up for certain types of absence that fall into protected leave. I will cover more on the certain types of absence in the upcoming slides. So in the example on the previous slides, the member would normally receive £510.20 each year, but then had a reduction dropping down to £255.10. This is where the protection comes into play, and as an employer, you should be looking at APP, as this is what the pension should be based on. The APP amount is also the pay the employer contributions are based on. So in scenarios like this, you would report the APP figure in replacement of the reduced pay received. So effectively ignoring the £255.10 and using the figure of £510.20, which I have highlighted to show the figure that would be used as the APP figure and should be reported to us. As stated, APP is designed to protect members' pension pots where they have had a period of protected absence. So during any period of protected absence, the employer must report APP to West Yorkshire Pension Fund so that we can calculate the member's pension pot based on the APP and not the actual pay received by the member. So APP would apply in the following protected types of leave. So you have ordinary maternity, ordinary paternity, and ordinary adoption leave, sickness and injury leave, and reserved forces leave. So APP does not accrue during any period of unpaid additional maternity, paternity, or adoption leave, unpaid shared parental leave, or unpaid parental bereavement leave. These are to be treated as unpaid leaves of absence. So you should report APP to WYPF as part of your monthly return file in replacement of the actual CPP earned, and you'd need to complete the record maintenance form to notify us of the absence period. You'd pay employer contributions on the value of APP and include APP on any leaving notification forms or retirement notification forms where applicable. So then why is pay so important? The pension savings for a member is strictly linked to the earnings in the care scheme, and it's how they build up their pension pot each year in the scheme. So at the end of each scheme year, we use the cumulative pensionable pay, CPP, to work out the pension a member has built up. The information you report to us allows us to actually keep members' records up to date, calculate pension benefits, but it is also the information that we use to produce pension statements. So therefore, it's really important that you report over the correct CPP or APP for any member who is affected. We do carry out cursory checks on the information you submit against what we already hold on file, and if anything doesn't look correct or we need to clarify, then blocks and quarantines are produced, which need to be actioned as soon as you're able. So please ensure you action any blocks and quarantines that you receive, as this can potentially delay us being able to produce pension statements for those affected members. We are running a series of employer webcasts surrounding the March return, blocks and quarantines. So please look at booking on the upcoming webcasts if you haven't already done so, or refer to the recordings that are available on our website. Now I'd like to touch on how APP is calculated. To calculate assumed pensionable pay for any employees who are paid monthly, there are 4 steps to follow. Step 1. What we would do is look at the pensionable pay received in the 3 months preceding the pay period in which APP becomes effective. So it's effectively the pay period where the pay has been reduced or nil pay. So for example, if someone has a reduction in pay in September 2021, we would look at the 3 previous months. In this instance would be August, July and June. We'd then need to take the average pensionable pay of those 3 months. So we do this by adding the months together and dividing by 3. We would only need to do this if there was a difference in the monthly amount from one month to the next. Step 2, we would take off any lump sums received during that period, so that's regular and irregular lump sums, essentially determining the basic pay and deducting any additional payments such as overtime, weekends, etc. Step 3, we would gross up to an annual amount, so effectively multiplying the average of the 3 months by 12. And step 4, we would then add back any regular lump sums during the 12 months preceding the effective date. A regular lump sum is a lump sum you deem to be regular and would have been paid regularly throughout the 12-month period. So if a member has only worked overtime twice out of the 12 months, you may deem this as not regular and therefore not add this back in. It's all about reaching a reasonable representation of what the individual would receive had they been in work and not on absence. Once you've calculated your APP, you then need to apply this to the period where the pay has been affected. If the pensionable pay the member received in the 3-month, 12-week period was reduced as a result of an absence due to trade, dispute, or an absence authorised by the employer, the reduction is to be ignored when calculating the pensionable pay received in these periods. For employees with multiple posts, you should carry out a separate calculation for APP on each post. And for employees paid on different frequency, please see the full guide for further instructions. So now we're going to look at an APP example. In this example, it is important to make note of the dates which are key in looking at calculating APP for a member. So in the example on the slide, the member went on to half pay due to sickness on the 17th of June 2020 and left the 31st of July 2020. So step one, you would use the date the reduction took place, and we would look at the 3 full months prior to the reduction. So this person went on half pay on the 17th of June. So the 3 months we're working back from the monthly reductions are May, April, and March. Step 2, you would deduct any regular or irregular lump sums. In this particular scenario, this member doesn't have any lump sums, so there's no action to take for step 2. Step 3, you would annualize the amount. So that's adding the 3 figures together from April, March, and May, and then times that by 4 to give us the annual amount of £13,600 for the APP figure. Step 4, we would add back any lump sums from the last 12 months. The reason we would do this is to fairly base the APP on what the member would normally receive, but as I've said in this particular example, there isn't any lump sums to add back in. This would then give us the annual APP amount of £13,600 and a monthly APP value of £1,133.33. You would then apply the APP amount to any periods where the member has had a reduction in pay. When applying APP, I would like to remind you of the key steps you need to be aware of. So firstly, you will need to apply APP from the first day the pay is reduced, and please be mindful as this can occur partway through a month. For any scenarios where APP is applied mid-month, pensionable pay you report that month will be a mixture of APP and CPP prorated for the relevant dates. We will cover this further in the example scenarios to demonstrate how this is treated. You need to keep paying APP until a member's pay stops being reduced or they leave employment. You will also need to be mindful of maternity. There is a maximum of 39 weeks that APP would be applicable. For any members where the period of absence extends over 2 scheme years, effectively crossing 2 31st of Marches, APP will need to be adjusted. The adjustment is based on the percentage specified by the Treasury revaluation order for the second scheme year ending on the 31st of March and would apply at midnight. I'm now going to work through a number of the most common scenarios you will encounter when dealing with APP. Throughout the examples, the steps in calculating APP still follow the steps outlined earlier in the presentation. The only difference is how we actually apply it and how this will affect the information that you will need to submit. If you do have any scenarios where you're unsure or need further guidance, please see the support is a now available slide detailing the contact details you can use to contact the employee relations team and your designated employer pension fund representative. In this first example, we meet Jane and is a relatively straightforward APP scenario. So Jane went on child-related leave on the 1st of May, which means in order to calculate APP, we would need to look at the last 3 full months prior to the effective date. As the child-related leave commenced in May, we will be looking at the previous 3 months, February, March and April, giving us £1,659.84 in February, £2,132.51 in March and £1,547.35 in April, providing a total of £5,366.70. As Jane has received different amounts each month, we need to take an average of the 3 months by dividing this by 3 to give us the average monthly amount of £1,788.90. This monthly amount is the amount you will need to report to us on the monthly return in replacement of any reduced pay that Jane is receiving. The member would pay contributions based on the reduced pay, but the employer contributions are based on the APP amount. To then annualize this amount, we would multiply this by 12 to give us the annual amount of APP of £21,466.80. Please note, if you've not already reported APP figures to us, the last opportunity to provide this information for the affected periods in any scheme year is on the March return. If Jane was to start the child-related leave on the 10th of May, so part way through the month, the process for calculating APP would still be the full 3 months prior to the reduction. So again, using February, March and April to determine the APP. The main difference here is that the pensionable pay for Jane and May would consist of both actual pay, so the CPP, and APP. CPP would be payable for the 9 days prior to the reduction, which would then be added to the 22 days of APP. The total of these two amounts added together is what you must report when submitting the information through for the May return. In this next example, we meet John. John has been on sick leave since the 1st of January. So he receives 6 months full pay up to the 30th of June and then is on half pay from the 1st of July. And therefore, as sickness falls in the protected leave category, APP now needs to be applied. But APP would only apply from the point that John's pay has been reduced. So there would be no change to the 6 months he was receiving full pay. Again, you look at the last 3 full months of pay, so April, June, and May. As John receives the same amount of pay each month, this simplifies working out the APP figure, as we can just use the monthly amount of £1,500. This would give us an annual amount of APP of £18,000. When calculating APP, as an employer, you have discretionary powers. So where the pensionable pay received was, in the opinion of the employer, materially lower than the level of pensionable pay that the member normally receives, the employer has discretion to replace the actual pensionable pay received with a higher level of pensionable pay to reflect the level of pensionable pay that the member would normally receive. So an employer must have regard to the level of pensionable pay received in the previous 12 months when working out what level of pensionable pay the member normally receives. If the annual rate of APP is lower than the pensionable pay the member normally receives, then as a scheme employer, you can substitute a higher figure. In doing so, the employer must have regard to the level of pensionable pay the member received the last 12 months. This can occur in circumstances where a member is on sick leave and they would only receive their basic wage as a result. However, prior to the period of absence, they may be in receipt of additional pensionable extras such as overtime and would normally give them a higher pensionable pay. So this is why we take into consideration any regular or irregular lump sums the member has received in the last 12 months so that we ensure that the members aren't disadvantaged of the resulting APP being lower than the pensionable pay they would normally receive. When determining if the member received higher pensionable pay, you can choose a period within 12 months from the pay reducing to calculate the APP. So you can either go back 12 months from the 1st of January when he goes on sick leave, from the 1st of July when he goes on half pay, or look at any period in between to determine the higher level of pensionable pay. As mentioned at the start of the presentation, there are other scenarios where APP is required and is used in the calculation of pension benefits relating to ill health retirement and where an active member dies in service. This is something that can be quite misunderstood across the board and can cause a bit of confusion, especially due to a member not having any reductions in pay as a result of absence. Logically, you would assume that APP doesn't apply. However, for the purposes of ill health retirement, when we're calculating the enhancements for Tier 1 and Tier 2, we will be asking for the APP. We do also ask for the APP for Tier 3, as this could be uplifted as part of the review later down the line. We do find we have to go back and ask for the information when they haven't been on sick. This can cause a delay in processing the ill health retirements. So please bear in mind you do need to calculate APP for ill health retirements, even if they haven't been on any periods of reduced pay or nil pay as a result of the protected absence. The theory is basically just the same. You would look at the last full 3 months and apply it from there. In addition, death in service, the regulations outline that we should base the calculation of the lump sum death grant and any survivor's benefits based on the assumed pensionable pay. So where a member dies in service, APP is used to calculate the death grant and survivor benefits. If the member, as with ill health retirements, had previously reduced their hours because of the condition that later caused or contributed to their death or retirement, then the reduction in pay is ignored when calculating the APP provided, as long as an independent medical practitioner has certified to that effect. Now we've worked our way through understanding APP and how it should be applied, where do you report APP to us? APP should be reported on the monthly return during periods of protective leave, such as relevant child-related leave, sickness or injury. You would enter it under the pay main column of the monthly return if the member is in the main care scheme, or the pay 50/50 column if the member is in the 50/50 scheme. The pay main column can include both CPP and APP, where a reduction applies part the way through a month. How are contributions treated during periods of APP? This is a good question and again can cause some confusion. From a member's perspective, the contributions they pay are based on what they are actually receiving. So if their pay is reduced, they will pay contributions based on the reduced amount of pay that they receive. From an employer's perspective, the employer contributions are based on the APP figure rather than the actual pay received by the member. So please ensure that you are paying the correct level of contributions during any periods of APP, and again notify us of the APP figure and the relevant periods. What I'd like to do now is just go over the absence summary as a point of reference covering the common types of absence, whether or not APP applies, whether the pension is protected, and then outlining the implication of the employer contributions that are payable. So if we look at the various reasons for absence, so we have ordinary maternity, paternity, and adoption leave. APP does apply. The pension is protected, and the employer contributions are payable on APP unless the actual pay is higher. So with child-related leave, you may have keeping in touch days, which would be based on their normal pensionable pay. So in these instances, you would need to take into account the higher pensionable pay for that period. We have sickness, injury leave. Again, APP applies, and again, the pension is protected, and the employer contributions are payable on APP. You've got reserve forces leave. Again, APP applies and the pension's protected. The employer contributions are payable on the APP, but these will be paid by the Ministry of Defence. You then have career break and strike breaks, which is where APP doesn't apply, the pension's not protected, and employer contributions aren't payable. What I would like to do now is just make you aware of some of the additional resources that are available to you to aid your understanding in APP. So under the employers section of our website, there are a number of fact sheets which will assist you, particularly the pay fact sheet, which covers the calculating and applying of APP, pensionable pay definitions and final pay definitions. In addition, you can access the payroll and HR guide under the employer guides and documents on the lgpsregs.org website, which provides further explanation of APP. The final resource I would like to make you aware of is the LGA bite-sized training available through the lgpsregs.org website. This can be accessed via the lgpsregs.org website. If you select the employer resources drop down on the home page and then employer bite-sized training, this will take you to a suite of short interactive courses that you can work through covering topics such as what is APP, calculating APP, APP and pension contributions, APP and the 50/50 section, APP kit, split and stringer days, and finally APP for ill health and death benefits. These are very useful as they are fun and interactive ways to improve your understanding, and they have tasks to test and reaffirm your learning. So they're quite the quick, short, bite-sized training to work through and expand your knowledge. If you have any specific scenarios you're struggling with or still require some assistance, then please do get in contact with the Employee Relations team who will assist you. The contact details you can use are displayed on the slide. You can use the Employer Contact Us page on our website to find the contact details for your pension fund representative. You can contact us via email on the Employer Relations team mailbox, or alternatively call the Employer Helpline for assistance. Finally, we have a wealth of information on our website under the Employer section at www.wypf.org.uk. This brings us to the end of our presentation. I hope you found this session informative and this has really helped you in understanding APP. I would just like to thank you for joining me today and look forward to seeing you on future employer webcasts. Thank you very much.